So hi everyone again to the latest in the webinar series from Fraction, the 5 big things. For those that don't know, I'm Nigel Biswas-Baldwin, co-founder of Fraction, and joined by a few other co-founders today also. So thank you to them, and also anyone joining as a partner for Fraction and anybody external to that, a warm welcome to the webinar. Just want to say first up that the meeting is being recorded, so it may be used for Fraction's promotional and marketing purposes. So appreciate your acceptance of that. If you're unable to do that, then with the greatest respect, maybe you'd want to dial off now. But if you're staying on, I take that as your acceptance. So today's in the latest seminar. We look at an ongoing challenge, the challenging world of biotech funding. And Sabine has much experience around this. And I was chatting to Sabine a little bit to understand sort of background earlier today. And I heard that Sabine is a self-confessed geek around understanding and making the numbers add up. So that's Sabine's sort of passion, if you like, but particularly in life sciences. In her career, she's CFO of startup biotechs, but also sort of international, more mature organizations. So Sabine has a very large CV of working with different types of companies, managing and bringing in finance into those companies. So I think very well placed to set up a discussion around the challenging of biotech funding. So with that, Sabine, I hope that's good billing. I'm sure you'll introduce yourself in any case. So over to you, Sabine.
All right. Well, thank you, Nigel. So yeah, so indeed, my name is Sabine. I did not start in biotech, but as my husband would say, you first need to slip around before you get married. So it took me a while to find my true passion, but I did land in biotech, where I started off as basically employee number 7, I think, for Europe. Of a US listed company who decided they want to also have a footing in Europe. So we started. So we went through the whole routine of indeed having clinical trials, having clinical trials fail. So we had to be very smart in terms of money. We had to say goodbye to some employees. Later we could hire some more. We did some acquisitions. We did some integrations. We had success. And by the time that we had the 3 compounds selling in 35 countries, Big Pharma came around and snooped us up. So I think that's something that is very very common, I think, in biotech when you're smaller. So my experience in biotech land more in the smaller ones. I've also done consulting work, also for Deloitte. So I've seen it from different angles. But my passion is very much on the business side of biotech finance. So yes, this is a finance webinar. I will try not to bore you too much with too many numbers, but there will be numbers. And when there will be numbers, they are typically for the US and for Europe. So yeah, let's go on to the first slide where we have some trends, if you will. So I think we all agree that biotech is a very resilient industry. So we are linked to an unmet medical need. People need us. We are also used to having uncertainty and risk because you never know with compounds and clinical trials and what have you. And typically we weather basically any storm, but we're also not immune to high inflation and interest hikes. And that is very much where we sit today, and it also drives the big funding discussion that we have today. So let's unpack that first statement. So in terms of inflation, like every other industry, we have very high, historically high interest rates at this very moment. Europe is around 9%, the US around 14%, which makes everything much more expensive. If it's labor or transportation, materials, what have you. The other interesting thing is that we've also seen, although it is a defensive industry, people did postpone purchasing prescription medication. So besides the pressure on the margin, if you will, we also seen an effect on the total volume of products being sold, which is quite interesting. So another thing that we saw, because inflation went up the governments in Europe and the US then decided they needed to counter that, and they were starting to increase interest rates, which again makes it more expensive to do business. So besides the pressures from the expense side, we also have pressures from the pricing and reimbursement side. We see that both in the US with the introduction of the Inflation Reduction Act, where they try to look at costing and it's more difficult to get products approved. But we also see that getting more and more difficult in Europe to get pricing approved. So we basically have on both sides of the P&L that it is more difficult these days. So I mentioned interest rates. So what happens when interest rates goes up? If the interest rates goes up, your cost of capital also goes up. So which makes it less and less interesting for investors to invest in us. So what happened there, and we will get more details on that later, but basically the years 2020 and 2021, it was a big boom and everyone was investing at IPO, the initial public offerings, were at an all-time high, if you will. But if you now look of those companies that came alive in 2020 and 2021, by the end of 22, 91% of all those companies saw their value decreased. And some of them even by half of the value. So it's just an indication that maybe it was too good to be truth, that it was that there was so much money in the years 2020 and 2021. But I will touch more on those, but I just want to lay it out here that, we had basically a diminishing IPO activity, which makes now everyone say that it's very difficult to get money these days. On the more positive side, I had insight into a Deloitte survey around many life science C-suite executives, and 48% of them are cautiously positive about where we are going in biotech land, and another 22% on top of that is actually even more bold. So I think when people say these days that you can't get funding, it's all very difficult. It is tricky, but as we often say, it might be tough, but we are tougher. So I think we will be fine in the end. So let's maybe move on to the next slide where we, So here for funding challenges, as I said, obtaining funding was extremely tough in 2022. In the years 2020 and 2021, very much inspired by the pandemic, basically anyone with an idea, if you will, could get money. So therefore, the initial public offerings were out of this world. And in 2022, basically we had a decrease of 93%. So typically it has a ripple-on effect. If the IPO market practically disappears, the venture capitalists also have no way to make money. So they are starting to reduce, and people have to become more and more creative in terms of how they can get money out of their business, right? One of the strategies that are then often looked at is to do mergers and acquisitions. But we've also seen in 2022 that mergers and acquisitions as such, the hardcores also didn't happen. It was more about alliances and partnerships, which is a good thing and a useful thing. The downside of those type of deals is that very often there's no cash up front. So, and that's very often cash is king and people need money. So that is a bit of a challenge. Before we go on to the next slide, where we see a graph, which I think is very insightful. So there's probably one important closing remark is that the struggle for funding was indeed much more pronounced for early stage investments. So the emerging biotechs with a more de-risk, more later stage asset are more attractive. So the funding for them was easier, but the earlier on you were in the life cycle, the harder it was to get money in. So yeah, please interrupt or ask later if I go too fast or if clarifications are needed, but kind of the lay of the land. So a lot of it is definitely yeah, tricky to get money, but it's definitely not as bad as people think it is. And the next slide will definitely show us that as well.
Sabine, are we climbing out? That's the big question, because obviously this data points to 22. Are you getting any signals to tell us that the terrible 22 is now over and there is a bit of money?
Yeah, I think so. My belief very much is that there is money. Clearly, as you see from this graph, which is quite interesting. So in here, you see how much capital was raised in Europe and the US between 28 and 22. So you see what is venture capital, how much came from banks, what was IPO related, so the first offerings, and then the follow-ons, basically the second rounds of offering in the market. So if you look at this, clearly it stands out that 22 was the lowest in the decade. But if you take out the high years of 2020 and 21, you also see that it's basically the annual financing average of the last decade, right? So the IPO market is practically gone. So that is very tricky, and that might come. But when I was talking to Nigel a bit earlier, it is almost a bit comparable to the dot-com boom, where there was a time that you could sell anything, right? And then people came to the realization that it didn't work out. So the fact that our IPO market is very small is understandable and very doable. That debt is lower than it has been also makes sense, because yeah, we have higher interest rates. So once we get out of this recession, and well, that might not happen in 23, but we will get out of this recession, interest rates will go down again, and then we will have more breathing space in that area. And the big red where you have the follow-on and the other, it's very much also related to the regulatory uncertainty and the approvals and what have you. So I think it's also something where people need to get a bit more confidence again, although biotech, there's always a risk, right? So, but if you look at it, it's not as bad as people say it is, right? There is still money. It's just very different, maybe a bit very different these days, how you get that money. And I think there is that the emphasis needs to be on the resilience and on the adaptive strategies, on how you get that money. And a lot of it is related also to innovation. I think if you are the best scientist in the group, you won't get the money per se. I think when you listen to the market and what you hear is that they look at almost more as a package deal, right? So you need to be good scientist, but you also need to have a very good management team. So you need to be innovative. You need to have innovative products. You need to have innovative technologies. When we had that last WebEx about artificial intelligence, that also illustrated that things will become more efficient and effective. And those are good investments for a company to make, because I think in the end, that is where investors look at how ready are you for the future? Are you managing your finances in an effective way? A challenge that is also seen is that with those new needs to a certain extent and everything in AI and machine learning, is that there are not enough talents, not enough people who can do these jobs today. So that is a bit of a challenge. That also helps that for companies, if they need to get those profiles in, that if they can't hire them, that they can rent them, right? I think that's also another dimension that we see. Also for funding, I am currently working on something where we basically, the management team between brackets, we're all consultants. No one is on the payroll, right? It's almost a fraction idea where from it's a US company, they are listed, they have a product that actually funds the build of Europe, if you will. But until they have the certainty about approvals and what have you, they will stay mean and lean, right? So that's also where, where profiles like fraction really work out well, because I don't work full-time on that. And they don't want me to be working full-time on that. nor make that commitment. So I think the very long answer to your question, yes, we will get out of it. We also need to get out of a recession. That's definitely there. And you need to be innovative, right? And I think on the later slide, when I think maybe even the next slide, when we talk about financial strategies, I think we need to be more clear about who we are, right? And in finance, we sometimes have the saying like, yeah, you create value in the future and you need to be good at what you pretend to be good at. And that is all about what also creates your culture, your value proposition towards your payers, your employees. So yeah, so that's definitely there too. Mike, if you can maybe, or unless someone has a question about the wonderful graph, obviously. No, I don't think so. Okay, so then let's go to the next slide. So as you see, I have been building up to this slide, if you will. And this is also why finance is fun, because in the end of the day, everything that happens in the business comes together in the numbers and in the finance. So finance is not about making the book balance. It's really about creating value. And how do you create value is making good investments and also be adaptive in these days when it's hard to get funding, but also when clinical trials don't work out and you have to survive until you have your next milestone that hopefully is more promising. But what we also see in the last WebEx, but also by reading everything, it is about being innovative, being lean. One of the other elements is that if you really look at financial management per se, the hardcore financial management is not something that it's one size fits all. You have big companies with big problems. I did an assignment for a very big medical device company, and they had more than 200 systems. And the order that went in was not the order that came out, and it was a big problem. But instead of fixing that issue, they were more focused on outsourcing the people handling all of these issues to India. Right? So it's quite interesting sometimes to see how we try to fix a symptom versus to fix the problem. So therefore, I think that I am definitely an advocate for the let's fix the problem approach to things and not to patch something on it or throw low salary resources at it, if you will. So yeah, for managing operational spending, there's a lot of different examples to be given there. I've done many different things in that area. But by the end of the day, it also comes down to people. So you need to have good people. You need to have flexible people. And you need to have good systems and a lot of forward-looking vision in your management team. So whether it's hired people, if it's consultants, if it's fractional people, it doesn't matter, right? So and that kind of goes again towards my last point on this slide, is that you have to be really clear about who you are. I think the days where you can kind of pass through by being the best scientist or the best something only doesn't do it. I think you need to have it all, right? So you need to, you need to have the best people around you and have a convincing story. And then there will be funding. I think I'm ready to go to my next slide. I know I'm very, well, maybe I'm a bit fast. So yeah, so my conclusion, if you go back, sorry for that. No, that's all right. At the risk of repeating myself again. So yes, 23 is still very complex and uncertain. We've also seen that a lot of the execs are getting more and more positive. So we need to get through this, but we will get through this. and there is definitely funding available. You also need to find funding that works for you. Not everyone wants to have money from a venture capitalist. Not everyone wants to have a bank loan. Not everyone wants to go in an alliance, but sometimes you have to. Right? So the mergers and acquisitions were at an all-time low in 2022. Also, the big players didn't play. But I think now that we're slowly getting over the whole pandemic excitement and we're getting ready to look at new compounds and new products, slowly, I think more M&A activity will also appear. I think that's it. Maybe when you have a question or a remark, something else sparks my
one of the companies I worked for had very, very cheap stock. They were floated. And one of the thoughts they had was that their stock wouldn't rise in price. They had some good data. But is there any reality in the fact that if you've got stock that is worth a couple of cents or a couple of pennies, that puts you into a junk stock sort of category that makes you less investable, or is that just not really relevant?
Well, I think as long as your total market cap is in line with what you feel is the value of your company, it doesn't matter really if it's in small bits or in big bits, right? So typically, if your share price is too high, also investors don't want to invest. Right, so that's why sometimes they start splitting shares.
Yeah.
But yeah, if it's really penny shares, that might be a bit different. But I think you have to look at what is really worth it, right? And that's by the end of the day how people in the money market make money, is that they make an assessment of a stock and they think, will it go up or will it go down? Is it overvalued or undervalued?
Yeah.
So if indeed you if you want to consistent with your story, you need to have a good story, right? Another interesting statistic maybe is also that by the end of 22, they did an analysis of all the biotechs with not that much turnover, about 500 million a year, but out of those, 55% did not have enough cash to survive 2 years, right? And another 29% did not even have enough cash for 1 year. So if you think of that, right, cash, where in a land where cash is king, you have to be really smart, right, about how you get your cash and how you keep your cash. And in the US, that's even further complicated these days, is that, as I said, very often we see that US companies have 1 or 2 selling products in the US, and then they want to set up an organization in Europe, right? Or reinvest it. But in the US, we have quite some drugs that are coming off patent. And therefore, they will start losing their money stream, which will have a ripple effect on the funding question again, right? So it's a very long-term proactive approach these days of funding. You can't say this is it and this is how you need to do it. You really need to look at every company and every compound and which stage are they in.
Thank you.
Thank you, Smeen. Are there any other questions?
I mean, how far do they normally plan ahead in terms of funding? So the companies, right at the very beginning, do they sort of map it out from, obviously seed funding, A, B? Do they map the whole thing out, or do they just take one stage at a time?
Well, I think if they can, they would love to map it all out, but I think it's already sometimes difficult enough to get one route of funding, right? So that's where you saw on the graph, you had initial funding, for example, and then you had the secondary offering. So that's linked then to another milestone. So it is, I've seen cases where they are ready to commit to, if you meet that milestone, I will give more money, but it's all milestone related, obviously. That's with the venture capitalists, and that's also why working with a VC gives so much pressure, right? You can map it all out, but if you don't make your milestones, or if you can't bring it, or you don't have a sellable product if it doesn't work out, or you can't get an IPO to get all the money in, your VC will also be very unhappy. So I think you need to look at it at the business case level. So really from beginning to end. But you need to have contingency planning as well, obviously, because you won't get guaranteed funding. If you make the next gate, you get more money in the next gate. Yeah. So I've seen both cases.
Thank you.
Sabine, another question. If you look at the funding mix that we saw in 22, IPO's gone. What do we, with interest rates where they are, which band of funding is likely to come back first? VC? Do we think IPOs are? Because I suppose what we've got is people that can earn 6% on their money doing nothing.
Yeah.
So if we looked at that graph, I don't know, 21 to 22, I mean, IPOs are wiped out, but as you said, we've got a healthy amount of venture still there.
Yeah.
Somewhat a healthy amount of debt, a pretty crushed follow-on. So what do we think is going to come back?
Well, the venture capital, if you compare it, it is down, but not as down as it was before, right? So if you compare where we are, the 22 levels are not too far out versus the levels before. But and I think the VCs have money, right? So they have just been more careful these days of where they spend it on, right? And that's where some people actually believe it's a good thing that now we have a more modest IPO market, because IPO and VC are a bit linked, right? Because in the end, the VC puts the money in and they want the money out, right? Where we are in it because of the unmet medical need and we want to do good for people. The VC doesn't have that warm and fuzzy feeling. They just want to have the money out by a certain date. Right. So I think the VC, they will go up, but they are pretty much where they were before. Once the interest goes down again, clearly that will be easier to obtain as well. And yeah, the follow-on debt is a bit. I actually think that the first one will go up will probably be the follow-on, by the simple fact that people are a bit more cagey, also with the macroeconomic situation where we are, and with the uncertainty of the approvals and the other uncertainties. I think we are a bit more scarred, maybe. We're like, well, will it all work out? And let's see how this goes. So I think once we have more, gain more trust, if you will, I think the follow-ons will first grow.
Thank you.
Yeah. Could I ask about the early stage projects, the discovery phase? You mentioned that those are, affected more, if anything, because people want de-risked projects. Do you see funding for early stage projects coming back anytime soon?
I think they will. It's a harder sell. So if they can choose between two, they will take the safer bit closer to regulatory approval ones first. But you can, and I think it's also about the story that you have, the team that you can present, and the business case that you have, and so
it seems as if somewhere in your pitch you've got to put the letters AI if you want to get any money at all.
You clearly need to send more letters these days. That's unfortunate, but there is funding. It's just we're all a bit more careful where we spend it on these days, but there is money.
Thanks.
So thank you, Sabine, again. Just maybe picking up on our discussion earlier. I mean, you can carbon date me a little bit back into biotech, into the late 90s and .com boom, and then what we've seen in the last couple of years, or 2021, sort of an explosion, if you like, in in investment and underlying values of companies? And can you make an argument now that perhaps we're entering a more sensible period, and that's actually good for everybody, where you can actually put correct valuations to companies, and then investment will come in a more sensible way, and that's maybe the path forward, rather than this roller coaster that we see, you know, through the cycle. What's your thoughts there, Sophie?
I do think that definitely the years of 2020 and 2021 were, it was too much, right? Everyone jumped in, and the money was, sorry, the market was, I think to a certain extent, was overvalued, right? And also further supported by the fact that 2 years later, a lot of these companies did not even have half that value left, right? Some are not even listed anymore, right? For a good reason. So the fact that it is a bit more down to earth, there's more scrutiny. There's actually a lot of experts that say it's a good thing, right? That there's some more normalcy here now, right? Yeah. It's harder to get, right? It's where I think for 20 and 21 it was almost like if there's a high risk, there's a high reward, and we all thought that we had that one brilliant idea. And now I think everyone realized that no, it doesn't work that way, right? It's still you need a very good science, and I think the fact that pricing reimbursement is more difficult now, getting a good price, makes it a bit more difficult as well to be in biotech in general, right? On how you make money, which also reflects then in to a certain extent in getting funding, and also in your financial success going forward. So I think overall, and also in the US with the regulation that they have now, it is, the landscape has changed. Not everything is good, right? So I think the discussions that we now need to have about pricing and reimbursements are sometimes really tough. But they do it to protect in the end the overall pot of money that is there. So I understand why they're doing it, but I can also imagine that they need to loosen it at a certain moment because, prices need to be approved, right? So it is. I think that there's a lot of elements in there that I like. It's more down to earth. Right? How are you? Are you resilient? Are you ready for the future? Do you have a good team? Are you really worth the money that you say you are? So there's a lot there. So, but yeah, the pricing reimbursement is probably the biggest hurdle. Yeah, and then inflation, but that's really out of our control. So, but therefore you also quite see that the relationship building, or the relationship that typically has been built with all the pricing reimbursement agencies is so important to get products approved, and having prices approved, I mean, right? So did I answer your question? I think I did.
I think so. Thank you. Absolutely. So the future is bright, I think.
Well, it's tough, but yes, I really think, it's my personal belief that it will be tough for a little more, but there is definitely light at the end of this tunnel. So it's
good to hear. And maybe I picked up also that, you know, we just need to be more flexible in our approach, and maybe sort of a fractional resourcing model.
You and I talked about it, and that's also what I've seen personally, right? Companies do not want to engage necessarily in getting so many people on the payroll and being so I am a firm believer, therefore I'm a very happy fraction partner in this model, because you need that flexibility, and in the end you don't work full-time on the product. So I think that it definitely sits within the ideas about how to manage a company. I think when you're really well established, then consultants might be expensive, but definitely in early stages, keep it flexible.
I think a shared experience. So Just conscious of time, everybody. I don't know if any burning questions left from the team. No, going, gone. Well, with that, thank you very much, Sabine, once again.